It's Thursday, July the 28th. And I knew last week that we were going to be in a recession. You know how I knew that we were going to be in a recession?
How'd
Because
you know?
everybody in the Biden administration was running around trying to redefine what a recession is.
They even brought in organizations, the National Bureau of Economic Development.
So that's 8 economists in one room with 8 different opinions, I'm
Opinions,
assuming.
and they being Washington has now turned to that organization and said that the what was thought to be the test, 2 consecutive quarters of negative GDP,
Which has been around 70 years.
right,
70 years.
which in addition to the fact we have an inverted yield curve.
Correct.
So I got 2 things here that's historical, that's been a definer in our career to say we're in a recession. They don't really count anymore.
Well, no, and it's all politicized, but as we have said in many of our videos to you, we've said that we want to go ahead and get it over with. Let's just go ahead and rip the Band-Aid off, and hopefully we'll get the clock started on this recession. Well, in our world, the clock has started, and we can operate knowing we're in a recession, which means that every day that passes, we're closer to being out of a recession, which lasts somewhere between 10 and 14 months on average. So tomorrow, you'll be one day closer to being at the end of the recession.
What was interesting this week was a question we talked about on the show earlier of why did the NASDAQ jump so much and take the lead on the day that the Fed increased at 75 basis points? And Gibbs' answer on the show, if you had a chance to hear it, if you didn't hear it, you can go back and listen to it, was spot on. The market, meaning the people that invest in the market, all of a sudden realized that, hey, were great technical stocks or companies that are technology companies that are on sale, and this might be a good buying opportunity to buy in. And in addition to that, technology is going to be a cornerstone of our portfolios going forward forever and ever, amen. And so therein lies, why not take a good buy in it? So the market took advantage of what is going on. Now, the challenge that's going on is the Federal Reserve right in that the inflation is going to roll over, or are they still behind and they're going to have another 75 basis points or another 75 or even a 1% increase? And that won't be known until things unfold.
Yeah, and the spread differential between the Fed funds rate, which is now at 3, and inflation at 9, that is a huge gap of 6. So I think they've got much further to go to get the inflation down to meet somewhere in the middle. So, I'm looking at another 200 basis points, which may or may not be the right number, but it seems to be kind of a logical number. And if that's the case, that means there's going to be more pain and suffering. Mortgages have rolled over. The mortgage industry's rolled over. Banks are laying off more and more people, especially in the mortgage side. So we're going to start to see hiring freezes, and we're going to start to see more layoffs, which will increase the pain, which means markets won't react positively. It's why we're still not bullish yet on buying some of the things that you just talked about.
All right, so here's what you're going to see happen probably in the next 30 days within part of the cash that we still have on hand. Remember, May, June, we said we saw individual high-quality corporate bonds move into an area for a 1 or 2 year that we felt would be a safe, reasonable rate of return that we would accept. And we spent some money and invested in that. We said we're going to hang on because of this rate increase that just occurred. It occurred. We're now going to go shopping and see if we can find a 1 year, a 15-month, a 16-month individual bond for part of that money and lock money up at a higher rate. We're looking in the 4% range if it is in that range to get. That's still going to leave us cash. That cash then, in all likelihood, will be used to buy into opportunities in the market when we think a good dip has occurred. And for the first part, we'll be buying into things that probably will be dividend driven, but we're going to add back to the growth piece of this. So you'll see activity this fall with what we're doing, slowly trying to build back, but still being defensive. Remembering then next year, even if we're in a recession, we have maturing dollars coming due because of the 1-year notes and bonds we bought, and then that's going to give us dry powder to make decisions with.
And we'll leave an adequate amount of cash behind in case we're wrong, and
Right.
those opportunities present themselves earlier than what we anticipate.
Right.
So we're threading the needle as much as we can, and always remember, it is your money.
And your money matters, and thank you always.